What we're going to do now is look at the way that taxes will alter some of your decision-making process. In particular, we're going to get at the point that in a business context, it often makes more sense to replace a perfectly well-functioning asset in situations where you wouldn't do it as a private person. So what we're going to look at here is just going to be the purchase of an automobile. And what we've done is we've said that we're going to buy this $10,000 automobile. This is what the cost basis is. And what we have here in this column that says car, these items right here, is what the cash flow on this replacement automobile would look like from a personal finance point of view. So the idea is that you have this perfectly well-functioning car, and what you're going to do is just going to replace it with another car that costs $10,000. I know $10,000 for a functioning car sounds a stretch, but it makes all the math nice and simple. Now the first thing that we're going to do is going to show you that once you jump into a business context, there are some other expenses you need to worry about. The reason why there aren't any other expenses here is to assume that this car that you're buying has the other same cost characteristics of the other one. So we're just looking at the change, which is the purchase. The next column over shows the amount of depreciation that you have in each year that you own the vehicle. Now it's assumed that you're going to keep the vehicle for the entire time. Because it's an automobile, you know it's a 5-year asset. This column right here is that modified accelerated cost recovery system table that you've seen a couple of times before. In order to get the depreciation each year, all you're doing, if you take a look at the formula here, is taking the cost basis, which is $10,000 down here, and multiplying it by that fraction of the cost basis you take as depreciation each year that's given in the table. So the first year you get $2,000 worth of depreciation. The second year you get $3,200. The third year you get $1,920, and so on down the line. Key thing to remember if you're using the modified accelerated cost recovery system tables is that it's just cost basis times the number in the tables, and if you add all these guys up, you end up fully depreciating the asset. Those all add up to the original $10,000. Now, again, depreciation happens when you're in a business context, and because you have depreciation, what you have are additional expenses. Even though it is this weird expense that isn't represent a check that gets sent to anyone else, it still represents an expense which reduces your taxable income. So the idea is that you can take that depreciation expense and say, this is how much my taxable income will fall by. Now, in order to get at what your tax rate is supposed to be, I've gone ahead and created a couple of tax scenarios here. And what we did is we said, well, this is going to be a large corporation. This is going to be a corporation that has a 35% federal tax rate. And at the same time, we situated this guy in Oregon and gave it a 7.7% tax rate. So this car actually represents a really small change that this business is thinking about making. And what we're actually looking at here is how the cash flows change when you go ahead and make this one small purchase. What I've created here is that federal and state tax rate. I've stuck them together in order to get the combined tax rate. What you're doing in that case is just taking the sum of the state and federal tax rate and then subtracting off the product, and that's what you should see there. So it's just 0.35 plus 0.077 less the product of 0.35 and 0.077. So this tax savings that we'll eventually get up to right here is simply that increase in depreciation, that increase in expense times the tax rate. And so what this represents is in each year, because of depreciation, how much your taxes go down by. And so please note that this is just directly proportional to the amount of depreciation. The first year, there's quite a bit of a reduction in taxes because of depreciation. The second year, it goes up, and then after that, it goes on down. Well, what I'm doing with the next column is I'm saying, well, this is going to alter our cash flow. And so what I'm going to have here in this column is the after-tax cash flow. What we're doing here is we're adding in the cash flow that you see from over here, which is kind of the pre-tax, or what it would look like from a personal point of view, and then adding in the tax savings. So if you see the first year that you purchased the vehicle, while originally in this pre-tax sense, in this personal sense, you're going to see a $10,000 reduction in cash flow that particular year. You see that the reduction in cash flow is a little bit smaller. It's $9,199. But what's interesting is that every year thereafter, because you purchased the vehicle, you're having depreciation, and because you have depreciation, your taxable income is down. Because your taxable income, your taxes are down. And so every year thereafter, you actually have a positive cash flow from buying this asset. Now, in order to show you how it is that this personal point of view is different from the business point of view, I've given you a minimum acceptable rate of return here of 5%, so we can start looking at the present worth of these two assets. Now, we're bringing everything back to year one, and so from a personal point of view, replacing your car is just simple. It's just the cash that you paid for it, $10,000. You don't have any tax savings, so that's all you have. But what this number right here represents, and again, what I've done is I've created the net present value of that stream of benefits and costs. The net present value in a business context is something which is a little closer to positive infinity. Stretching this out a little bit, oops, there we go. What you're seeing is that these folks, because you're in a business context, have a present value of that cash flow of only negative $6,326 as opposed to the $10,000 that you have on a personal finance basis. This means in a personal finance basis, in order to warrant replacing an existing vehicle, you have to come up with $10,000 worth of benefits. Whether that's $10,000 of you really like the feel of leather seats, whether it's $10,000 of sunroof that you want to have, is it $10,000 of heated seats? You got to come up with $10,000 in order to make that financial leap to replace an existing vehicle. But in a business context, you only have to come up with $6,326 worth of benefits because there's already some built in because of the tax savings. So if you're going to have slightly higher sales or something along those lines, this starts to make sense. So the main thing I want to get across here is that in a business context, you're often going to find that you replace vehicles at a much faster rate than you do in a personal context. Now, if you think about this, you've seen it happen before. You have tools in your garage that maybe are second-generation tools. When you go to work, you get the newest tools that are available.